Sources of short-term financing, Chapter 8, Part 1. Chapter will cover trade credit from suppliers, bank loans, commercial paper, and collaterals for larger amount of borrowing. Trade credit. Approximately 40% of short-term financing is in the form of accounts payable or trade credit. Accounts payable is a spontaneous source of funds, grows as the business expands, and contracts when business declines. Payment period. Trade credit is usually extended for 30 to 60 days. Extending the payment period to an acceptable period results in alienate suppliers, diminishing ratings with credit bureaus. Major variable in determining the payment period is the possible existence of a cash discount. Cash discount policy allows reduction in price if payment is made within a specified time period. Example of 2 to 10 net 30 cash discount means reduction of 2% if funds are remitted 10 days after billing. Failure to do so means full payment of amount by the 30th day. Cost of failing to take a cash discount. Discount percent over 100% minus discount's price times the 360 over final due date minus discount period. Net credit position. Determined by examining the difference between accounts receivable and accounts payable. Positive accounts receivable is greater than accounts payable and vice versa. Larger firms tend to be net providers of trade credit, relatively high receivables, and smaller firms in relatively user position, relatively high payables. Bank credit provides self-liquidating loans. Use of funds ensures a built-in or automatic repayment scheme. Changes in the banking sector today centered around the concept of full-service banking, expanded internationally to accommodate world trade and international corporations. Deregulation has created greater competition among other financial institutions. The longest on record since the Great Depression of the 1930s forced many large banks on the verge of collapse. With the enactment of the Gramm-Leach-Bliley Act in 1999, commercial banks and investment banks were allowed to merge. These combinations were responsible for banks to take excess risks, which led to the credit problems that started to show up in 2007. Prime rate and LIBOR. Prime rate, the rate a bank charges to its most creditworthy customers, increases as a customer's credit risk increases. And LIBOR, the London Interbank Offered Rate offered to companies having an international presence and ability to use the London Euro-Dollar market for loans. Here's prime rate versus LIBOR on US dollar deposits, just as a comparison. Compensating balances. An average minimum account balance to be maintained as an alternate for fee charged by the bank for services rendered. When interest rates are lower, the compensating balances rise. Required account balance computed on the basis of percentage of customer loans outstanding and percentage of bank commitments toward future loans to a given account. The amount that must be borrowed is calculated by taking the needed funds and dividing by 1 minus C, where C is a compensating balance expressed as a decimal. For example, if 100,000 is needed, the amount borrowed must be 125,000, considering 20% of amount borrowed as a compensating balance. This is computed as amount to be borrowed, amount needed, divided by 1 minus C, or 100,000 divided by 1 minus 0.2, so the amount to be borrowed would be 125,000. End of Chapter 8, Part 1.